Hi, and welcome to this very special presentation of Trading Places Live. I'm Tom Bowley, Chief Market Strategist at earningsbeats.com, and I'm really glad you've stopped by today. I plan to give you some insights as to how I view the stock market from both a short-term and long-term perspective. Hopefully, this presentation will give you much more confidence and lead to, like I said, hopefully much more trading success. If you enjoy this presentation and the way I look at the market and would like more outside the box kind of technical views, I hope you'll subscribe to my free EB Digest newsletter. Once you go over to earningsbeats.com, simply scroll down and there's an area right here to sign up for our free newsletter. It is published Mondays, Wednesdays, and Fridays, usually out about 8:30 in the morning, maybe an hour before the market opens. It's a very quick read, simply 2 paragraphs and a chart normally. All it takes is a name and an email address. Hit that subscribe button, we'll get you started. No credit card required. You can unsubscribe at any time. And anybody who's a subscriber to this free newsletter also is invited to our free events. So we always make sure we reach out to our community with room instructions when we do free events. So there's a lot of benefits to becoming an EB Digest subscriber. So I hope you'll take the time to go over to earningsbeats.com, scroll down, fill out that name, email address, hit that subscribe button, and get started. Everything we do, by the way, on that EB Digest newsletter is very educational in nature. I try to teach folks things that I've learned in the market, so I think you'll really enjoy it. And as I said, I think it can help you in your trading as well. All right. So in this special presentation today, I wanted to go through and just share with you some of the things that I look at in the stock market. I like to go out on a limb from time to time, call market tops, bottoms. I mean, most what I'm trying to do is just manage my risk. But I wanted to walk you through some of the things that I look at. I think most folks that follow me or have followed me over the years, if you had asked, I don't know, maybe 1,000 people that have followed me over the years back in December of 2021 to describe me, I don't know, probably 3/4 of you, maybe more, would have said, oh, Tom, he's a perma bull. He just thinks the market's going to go up no matter what. So you got to kind of have to disregard some of it because he's so bullish. Well, I'm hoping that after I go through this presentation, I'll dispel some of those myths. I think those of you who followed me for the last 6 months know better, but the market does go up a lot more than it goes down. So I think it's really important just to understand the history of the stock market and realize that when you're always trying to bet bearishly on the market, you're really setting yourself up to lose a lot more than win. The market goes up a lot more than it goes down. And I'll have some numbers I'll share with you in just a bit. Anyhow, let's go ahead and get this started. So I'm just looking at the last few years, and this is a chart of the S&P 500. Down below here, I have the XLY XLP ratio, consumer discretionary versus consumer staples. It's really my go-to when I'm looking at growth versus value or aggressive versus value, or growth versus value, aggressive versus defensive, those types of things. This is just a go-to. I call it a sustainability ratio. So if you look at it, it's almost a mirror image of the S&P 500, maybe a little bit more volatility, but basically it goes up with the S&P, down with the S&P, back up with the S&P, down. If you follow it over time, there's a really strong positive correlation between these two. And what I wanted to do is just show you a little bit about the way I evaluate the market. So from the low of the pandemic back in March of 2020, I think you can see we had a pretty steady run to the upside. The only period of really significant weakness during this period, I would say, was back at the beginning of September of 2020, where we peaked here. We had more than a 10% correction, and it was more than 60 days before we actually moved back up to a high. And this came at an all-time high, by the way. This September high right here was an all-time high. That day, all right, so that was September 2nd, the close on September 2nd. I'm going to show you an article I wrote. And this was back on September 3rd, 2020, before the market opened. So this is coming off that September 2nd high where we were at an all-time high. Instead of cheerleading, you can see my headline was a little bit bearish. 2 sentiment indicators suggesting extreme caution, beware. Now, let me start off here, just like I did in this blog article, by saying that I am bullish. I do believe the market's going to go up more than it's going to go down. I do think that we are in a secular bull market. So I wanted everyone just to realize that this article was really talking about the short term, not the long term. So, and then I went on to talk about why I thought the short-term risks were elevated. One, positive correlation between the VIX and the S&P. If you follow the S&P and the VIX, you know that they tend to move opposite one another. When the S&P goes up, VIX goes down. When the S&P 500 goes down, the VIX goes up. But there are times when they move together, and it's always when they're both going higher. Anytime the S&P is going lower, I can promise you the VIX is going higher, because lower S&P means more volatility, and more volatility means more premiums on options, and the VIX is based on those premiums. So as the premiums go up, the VIX goes up. It's an expectation of higher volatility. So whenever the S&P goes down, you're going to see the VIX go up. But every once in a while, the S&P goes up and the VIX starts to turn up. So you can see here, back at the end of August, early September of 2020, look at the 5-day moving average of the VIX turning up while the S&P kept going up. So the S&P was going up, but the market was getting more nervous. So that was one problem that the market was running into. If you look at these correlations, normally we're down here near -1. It's usually they move opposite one another. But every once in a while, you'll see these moves where we actually show positive correlation. And if you look at these, every one of these moves that you see, anything into positive territory on correlation, tended to mark significant tops in the S&P 500. The one I just talked about, that I showed you right here. Whoops, right here. This September top, that was September 2nd. That's what this is marking right here. That was the highest positive correlation that I had seen ever between the VIX and the S&P 500. It means fear was really ramping up as prices were hitting a new high. That's a problem, because if you go back and look at prior times when we've just gone slightly positive, you'll see that we're either at or very close to a very important high. This was the only one right here that I would say really didn't work. Even these three, if you look at these, they marked short-term, very short-term tops where maybe we just got a 3 or 4% pullback, but they're warning signs. And so you got to be aware of that. That's a short-term warning sign. Then put call ratio, without going into a whole lot of an explanation. When you get really low readings on the 5-day moving average, the market's getting complacent. Here it went to an incredibly low level in June, and that marked that top before we pulled back. Well, look, it was down there again. So everybody is betting on the market to go higher. You don't want to follow the masses. So when we got to that extreme level, and we also had this positive correlation, the highest I'd ever seen, that was telling me we probably got some issues here. Sentiment was painting a bearish picture. And we had the worst period throughout this entire run. And this was the best 22-month run in the history of the S&P 500, at least going back to 1950. And yet during that, the only real significant weak period I called based on sentiment, just looking at my sentiment indicators, and wrote about it in real time. Now, when we got to the end of it, now that was a short-term call. Remember, I said, this isn't the end of the bull market. This is a short-term issue that we have. Now, I wrote another article a few weeks later that said bullish rotation suggesting bottom is in. Now, that was on September 26th, right about the time we bottomed. So what I saw, if you flip down here and go through the article, is this last week of this move to the downside, the S&P 500 went down to new lows. But when it did, technology actually showed leadership, relative leadership. Same goes for consumer discretionary and communication services. These are three aggressive groups that make up almost 50% of the S&P 500. So as we were going down to that final low, we were being led lower by value stocks, not growth stocks, not aggressive stocks. And that's usually a bullish divergence. And so again, that came in right at this bottom. Hit the top, hit the bottom. But those were short-term calls. The one that came at the end of 2021 was more, for me, I think it's a little bit longer term. So I called for a cyclical bear market at the end of 2021 and the early part of 2022. I've got articles, I've got webinar recordings, time-stamped, that illustrate that I was calling this in real time. Let's go back first to this article. It could be a very rough start to 2022. This was December 31st, 2021. So I pointed out the consumer price index, the core producer price index, and that this was the core consumer price index, core producer price index, both showing that inflation had really picked up. So, I mean, you can't deny it. Inflation was a problem. Personally, I didn't think it would be a long-term problem. It certainly lasted a lot longer than I anticipated. But it was a problem, and I think you can obviously see that. During that period, you can see while inflation was going up, money was rotating away from small cap growth and into small cap value. So the growth versus value proposition was weakening throughout 2020, really top late 2020, and then throughout 2021. But the big problem that I pointed out was this table, which summarized sector performance for the entire month of December 2021. Going back to this chart, you can see this last move up on the S&P 500 right here. That's what I'm talking about in this article. During the month of December, consumer staples gained 10%, real estate gained 10%, utilities 9%, healthcare 9%. Easily the four top performers. These are all defensive groups. Down at the bottom, consumer discretionary, technology, communication services. These are your three aggressive groups. They went up. So if you were looking at their chart back then, you would have probably not noticed anything. Hey, we're moving up. We went up in the month of December in all three of these areas. But what it showed was money rotating. The relative performance of technology had gone down. Same with consumer discretionary, same with communication services, technology, and consumer discretionary all started showing relative weakness. Meanwhile, defensive groups were all showing relative strength. And that was coming right at the time, if we go back to this S&P chart, when we were making our final high on the S&P 500. Look at this ratio, the XLY, XLP. I mean, I could put other ratios on here as well. All of the, what I call sustainability ratios, which normally go up to confirm that the S&P 500's rally is sustainable, every one of them had turned down. Most of them topped either in November or December, but all of them were moving down into early January as we set our final high. That's why it's so important to watch what's going on. Wall Street was repositioning. It didn't have confidence that the rally was going to continue. If Wall Street doesn't believe, why should we believe? And I believe that's what I wrote in this article at some point down here. Yeah, right here. Wall Street is losing confidence in this bull market rally, and so should we. That was December 31st, right before this. On January 8th, we had our Market Vision 2022 event. That's where we kind of forecast what we see for the year. Anybody there, and I've got video to prove it, the webinar that was held on January 8th. Anybody there, though, could tell you, I forecast 2022 with a line that went down for the first 6 months to 3,500. And then the second half of the year, I had the line going back up. So that the full year was probably going to be somewhere around the break-even level. But the first half would be a cyclical bear market. That's what I was calling for before any of this happened. So anyone who thought I was a perma bull had an awakening at the beginning of 2022. I'm not a perma bull. I am someone who has studied history and knows the market goes up a lot more than it goes down. So you got to beat me over the head with warning signs before I'm going to believe that we're topping, but I will call tops. Another interesting article that I wrote was The Great Divide. This was on January 4th. And again, talking about there was that move on that final move higher on the S&P 500. Look at the XLK versus the S&P 500. This is technology, relative strength. Moved to its lowest level in about 5 or 6 weeks. The S&P during those 5 or 6 weeks had rallied from 4,500 to 4,800. And technology was not the reason. Consumer discretionary. You can see topping in November. Consumer discretionary was not the reason the S&P was going higher. I think it's pretty clear communication services was not the reason. Financials were not the reason. And industrials were not the reason. All of these aggressive groups heading into year end were in downtrends. So the reason we went up was what I showed you over in this other chart. It was the defensive groups leading. Wall Street's buying defensive groups. If we've got a great economy ahead, we're at an all-time high on the S&P 500. The stock market is the best leading economic indicator. That's what they tell us. And actually, I believe it to be true. So with the S&P going to an all-time high, why is Wall Street moving into defensive groups and out of aggressive groups? That makes no sense. Which is why I started writing bearish articles at the beginning of the year. Now, more recently, June 19th, I wrote an article, Are You Prepared for a Major Bottom? This is it. Now, remember, back in January, I said the bottom would come in June. To be fair, I actually said I thought it would be 3 to 6 months. But the chart that I drew, that I annotated, took it out to June, down to almost 3,500. Our low was 36.36. Is that the bottom? I don't know for sure, but I think it is. And the reason is, number one, I believe we're in a secular bull market. This is a chart that I show quite often, but there are your secular bull markets, 1950s and 1960s, 1980s and 1990s. And then starting in 2013, when we broke out above this double top on the S&P 500, I believe that's leading what could be a 2-decade secular bull market. That would take us into the 2030s. It's 2022. Listen, we had the 1987 market crash right here. We had the 1990 cyclical bear market right here. 1998 cyclical bear market right here. 81, 82. I don't know. I call it a cyclical bear market that we had broken out above that prior high. If you wanted to lump this in still as part of that secular bear, I probably wouldn't argue that, that much. But I mean, we're splitting hairs there. Look at the 1950s and 1960s. These drops here, they may not look like much. These were cyclical bear markets. 66, 62. I don't know if we quite went down in the late 50s. That probably was close to 20%. But my point is, you can have cyclical bear markets in these secular bull markets. And that's what I think we're in right now. I think a few years from now, we're going to look back and this is going to be the blip, kind of like these, kind of like 87, kind of like 1990. That's what I think this is going to look like. So that's my big picture. Now, I want to give you some facts. These are facts about every bear market that we have had since 1950. Understand what these bear markets look like. First of all, the largest percentage declines were from 2007 to 2009, 2000 to 2002, beginning of 73 to almost the end of 74. Long-term, that's the key. Long-term secular bear markets, and they tend to erode a lot more than cyclical bears. The market pulls back, sells off a lot longer and a lot harder from top to bottom. Every one of these, year and 4 months, 2 years, 6 months, 1 year, 8 months. And this was that this was right before the secular bear market began. 68 to 70 was kind of an extended cyclical, but that again was kind of close to the period where the secular bear market began. That's another one where maybe you could put those 2 years into the secular. I wouldn't really squabble too much. It's kind of a gray area. But look at all the rest of these. Every other time since 1950 that we've gone down in cyclical bear markets more than 20%, they're all listed right here. This is all of them. 2022 through the June 17th low was 5 months and 13 days long, which was about average for a cyclical bear market. Some are very short, some last a little bit longer. Also, 24.5%, the average cyclical bear market goes down 27%. At the low, we were down 24.5%. So it kind of fits right in. But one thing I don't want you to lose sight of, this is really important to me. 1 year later, after the low hits for a bear market, 1 year later, I want you to look at these returns. The worst, if we can catch the bottom, the worst 1 year return that we've ever had, at least since 1950, from a bear market low has been a gain of 29.5%. The best has been 78% 1 year later. And if we just look at the cyclical bear markets, the average gain 1 year later is 42%. Do you realize that if I'm right about calling this bottom at 36, and we just have an average 1 year recovery, we'll be back up over 5,000 by mid-June of 2023. I actually think we're going to be higher than that, but that would be an average. That would be the average of coming out of these cyclical bear markets. We would be back up to, I think it's like probably 51, 5,200. I wouldn't be surprised. I think we could go higher. Maybe we're only back to 4,800, 5,000. I don't know. I think we're going to be a lot higher than we are now. But just understand where we are in history. This is a pretty bad bear market that we've been in. To give you one other stat, which you might find interesting, since 1950, right now, for the year, we're down, from 1231, I don't know, maybe we're down 22%, 23% year to date, going through June 17th. Do you know that there are only 2 years since 1950? If we finished where we are or where we were June 17th, 36.36, if we finished the year there and finished down 23% for the year, you know that only 2 years of the last 72 years have seen worse years than what this would be. That's assuming we just finish where we are right now. Some people are calling for the market to collapse. Good luck. I don't think that's happening. The only 2 years that have been worse was 1974 and 2008. The financial crisis and back during the oil embargo and all the, inflation, massive inflation issues we had, I would say those are two of the worst years in our history. 2022 is on its way. It's sitting right beneath those 2 years already. How much worse do you think it's going to get? The S&P 500 prices things in. You've got to be ready to pounce on the market when it sells off like this. All right, I just want to go through real quick the anatomy of cyclical bear markets. This was 1962. Just look at it, just for, here we go down. Final low, look at the S&P versus the Dow. Back then, that was like growth versus value. S&P was more growth oriented than the Dow. But at the final low, we saw the S&P turn up. Let's go to 1966. Moving down, the whole move down, the S&P was outperforming the Dow. So that would have been an indication to me that it was not going to last. It didn't surprise me that we ended up bouncing back and going to new highs. How about 1987? Look at this, just a big swoosh, kind of like the pandemic, very quick move down. But look, we actually went down and put in a lower low about a month and a half later. The NASDAQ relative to the S&P was actually putting in a higher low. Money was rotating to growth before we started recovering. That was the bottom. 1990. Here we moved down and the ratio moved down with it. But look at this final move down here at the beginning of 91. And look at growth. NASDAQ 100 versus the S&P moving up. Pretty amazing. 1998. Moved down. Pretty much the whole time we had growth outperforming though. Again, a sign that that was not going to last. 2018, big move down. Look at this final move down. And look at the QQQ versus the spider. And look at the XLY versus the XLP. Both rising while that was going down. And so finally, let me just end with where we are now. There's the high at the beginning of 2022. Here we go down. Look at the arrows, down, down, down. Let me just show you the QQQ versus the S&P going down. This last low, it rallied back. XLY, XLP going down, down. The last move down on the S&P, we saw a rally. Hey, you got to make your own decisions, but I just wanted to point out some facts about the stock market, about bear markets, so that you can make more informed decisions. I hope you've enjoyed this. And if so, please come over to Earnings Beats and sign up for our free Earnings Beats Digest newsletter. We'd love to have you. Happy trading, everybody.
Hey, Grayson Rose here with StockCharts. Thank you so much for watching. I hope you enjoyed that video. If you did, consider giving it a like down below, maybe leave us a comment, and if you're new to the channel, you can subscribe at the link up above. We're gonna bring you daily content from an incredible collection of technical analysts and financial experts.